Is Nifty 50 expensive or cheap? Most investors ask one question before investing. Is the market expensive right now? A common way to answer this is by looking at the PE ratio of Nifty 50. The Nifty 50 PE ratio is currently around 20. But does that mean the market is cheap or expensive? Not necessary. What is the PE ratio? PE stands for price to earning ratio. It tells us how much investors are willing to pay for rupees 1 of company's earning. For example, if a company earns 10 rupees per share and its stock price is 200, then the PE ratio is 20. That is 200 divided by 10. Investors are paying 20 rupees for every 1 rupee of company's earning. Why does Nifty 50 PE matter? The Nifty 50 represents 50 of India's largest companies. When the Nifty PE rises, investors are becoming more optimistic. Stock prices are rising faster than earnings. When the Nifty PE falls, investors are becoming cautious. Stock prices are falling or earnings are growing faster. Historical perspective, the Nifty 50 PE ratio has historically moved in a wide range. The historically low was observed during global financial crisis and the COVID-19 stock market crash. It fell close to 12 to 13. The low was 12 to 13 and historical average was somewhere around 20 and high it has achieved was more than 40. Below 15 it is very cheap. 15 to 18 is cheap. 18 to 22 is fair value. Currently it is 20, so it comes under fair value. 22 to 25 is expensive. Above 25 is very expensive and above 30 is extreme optimism. So with Nifty currently around 20 PE, it is close to its long-term average and appears fairly valued to slightly attractive rather than expensive. Markets can remain expensive or cheap for long periods. Is Nifty cheap today? At a P around 20, Nifty is not extremely cheap. Nifty is not extremely expensive also. It is somewhere near fair value. Why it doesn't look expensive? Compared with past periods of market euphoria, valuations are lower, speculations have reduced, earnings have grown. As earnings rise, even the stock price becomes more reasonable. Biggest mistake that investors make. Many people wait for the market to become cheap. The problem is that nobody knows when that will happen. While waiting, markets may keep rising, companies may keep growing, investors may miss years of compounding. What Warren Buffett focuses on? Warren Buffett does not try to predict short-term market movement. Instead, he focuses on buying good businesses, paying reasonable prices, holding for long periods. For most investors, this approach is often more effective than trying to perfectly time the market. What should SIP investors do? If you invest through SIPs, continue investing regularly. Ignore short-term market noise. Focus on long-term wealth creation. SIPs automatically buy more units when market fall, fewer units when market rise. This reduces the need to predict market direction. Is Nifty cheap? No. Is Nifty expensive? Not really. At a P ratio around 20, the market appears reasonably valued. The bigger question is not whether the market is slightly cheap or expensive today. The bigger question is whether India's leading companies can grow earning over the next 10, 20 or 30 years. For long-term investors, that matters far more than the market's valuation on any single day.